The top stories this hour. President Trump hit South Korea with 15% tariffs while touting hundreds of billions of dollars in investments into the U.S. India, meanwhile, to face a 25% rate, possibly going higher over its Russian energy purchases.
Hello and welcome to The Week Ahead on Nomura Podcasts. I'm your host, Andrew Ticehurst from our Global Markets Research team, and today's Friday the 1st of August. For global markets, our focus remains very much on tariff announcements, key macro data and central banks. Now, about a week ago, we saw a 15% tariff announced for Europe. That initially sent the euro higher, but sentiment quickly soured. Further tariff announcements for India and South Korea have followed, as you heard there from Haida Stroud-Watts from Bloomberg. And combined with macro data suggesting that the US economy is holding up, a key trend across global markets this week has been the stronger US dollar. But market moves can reflect positioning as well as the underlying fundamentals, and it would seem that the firmer US dollar and continuing positive sentiment could simply reflect that worst-case scenarios on tariffs have been avoided. After all, let's not forget that US consumers and businesses will still face higher prices on imported items. That certainly has not been lost on Fed Chair Powell, who gave us a cautious take this week, noting upside inflation risks, and that contributed to the move in the US dollar too. Now this week I'll be touching on some of these developments with a sharp focus on what comes next. It is a busy week ahead, so let's dive in.
A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed.
So let's kick things off this week in the US, and I'm joined here by Ruchir Sharma from our research team in New York. Hey Ruchir, we've heard a cautious message just there from Fed Chair Powell on tariffs and inflation. I wanted to step back with all these recent announcements on tariffs. How's it shaping your outlook for US inflation?
Hey, Andrew, it's great to be back. So definitely we had a flurry of tariff and trade-related announcements this week. But before delving into specifics and how it's going to impact inflation, let me tell you that overall, the announcements seem to be in line with what we are expecting. And it was actually overall a bit hawkish, and the tariff rate as of now and as we speak, we think that it's around 16 to 17%. So what we saw this week was that President Trump signed a couple of executive orders, and though there were some carve-outs, imports from Brazil got subjected to 50% tariffs. We had 50% copper tariff that went into effect. And additionally, Trump threatened to levy 25% tariffs on India and some additional penalties for buying Russian energy. Another announcements were, I'd say, de-escalatory, but not clearly dovish. So we saw that President Trump got a couple of deals with Southeast Asian countries. South Korea was actually an important one. And we also heard potential deals for Thailand and Cambodia. So Mexico actually got a 90-day reprieve from higher tariffs, but given that a huge chunk of exports are getting the USMCA exemption, we think that the net impact is pretty benign. So coming to how and what is going to be the impact of these tariff announcements on prices, we continue to believe that this is going to push up goods inflation in the coming months. So we shouldn't disregard the fact that despite all these deals and the rates being lower than what Trump proposed in early July, or in fact the Liberation Day, it's still a material jump in the effective tariff rate. So we think that the import front loading and inventory buildup and some sort of a margin compression actually cushioned against an immediate steep pickup. But going forward, we expect, and in fact, this is what Powell also said yesterday, that there is going to be a gradual pass through to prices, and it's going to impact inflation in the coming months.
Okay, got it. So many details there, so many announcements. Thanks for bringing us up to speed. And an effective average tariff rate of 16 to 17%, that is multi-decade highs, of course. Hey, now switching to growth. We had the Q2 GDP report this week. We've got an ISM number and more claims data coming out next week. Is there anything on the data side there that you'd like to highlight?
Yeah, again, so a pretty data-heavy week. But we saw that real GDP growth actually rebounded in Q2, broadly in line with what we expected. But as you know, that this print's been pretty volatile due to net exports in Q1 and Q2. So everyone's been focusing on domestic final demand, which actually slowed in Q2, suggesting that the economic activity is cooling gradually. So as for the data that we're going to get next week, as you pointed out, we have ISM services, and we expect that the index picked up in July to 52.4. So regional Fed service, they've been somewhat positive, and they've suggested that service sector activity actually expanded in July. As for the claims, we saw that they're moving lower and they're reversing their increase from last summer. So just summing it up all, what we are seeing overall is that things are slowing, but they aren't catastrophic, and the economy is doing fine. So it's a gradual slowdown that we are seeing.
Okay, got it. So slowing, but slowly. Hey, let's do a quick compare and contrast. I know you look at Canada, so let's go north of the border. We had a Bank of Canada meeting this week, and they've got their monthly jobs report coming next week too. How's Canada going at the moment?
So things are actually not pretty rosy for Canada. And we saw that actually the BOC meeting took a dovish turn, and for the right reason, since economic slack persists over there, and Canada still faces headwinds from tariff-related uncertainty. So the BOC laid out a current tariff scenario, and they expect that the growth would continue to slow and the price pressures would be contained. So Macklem was actually pretty dovish. He mentioned that though he did acknowledge some tariff-related price pressures, he said that there are good reasons to believe that these are going to unwind gradually. Their opening statement actually did retain an easing bias once price pressures have subsided. So definitely we think that the Canadian economy has fared better than what the BOC expected back in April, but things again are far from fine. And a good indicator to gauge that is the labor market. So labor markets are actually pretty weak. This week we saw that vacancies in Canada actually dropped to a level that we haven't seen since 2017. And as you pointed out, we have the labor market report next week, and we think that the U rate actually remained elevated around 6.9%, and job gains were modest in July. So again, the unemployment rate in Canada has remained elevated as compared to its GM peers. So looking ahead, we think that the weak labor market and headwinds to growth, they are definitely going to convince the BOC to cut once more by 25 basis points in December, once they're sure that tariff-related price pressures have dissipated.
Okay, got it. So definitely on the softer side in Canada. Hey, Rashir, thanks for coming back on the podcast. Great to chat with you.
Thanks for having me.
Now, moving to Europe, I'm very pleased to be joined here again by Andrei Szczepaniak from Nomura's research team in London. Hey, Andrei, how's summer over there?
Hey, Andrew, great to be on. Look, it's fairly raining, actually, so the summer seems to have eclipsed us.
I was thinking this is the rare period where your weather's better than mine down here in Australia. But look, let's get into it. Let's start with the UK. The Bank of England could be the highlight in the coming week. The Fed and the Bank of Canada kept rates on hold, but it looks like we're going to get a cut there.
Exactly, yeah. So look, we're forecasting a 25 basis point rate cut. We've sort of been expecting the Bank of England to cut gradually, so once per quarter in the middle month of the quarter. So those are the all-important monetary policy report meetings. Market pricing is at the moment, give or take, 23, 24 bips, so essentially fully priced in. In terms of the vote split, that could be fairly interesting, as it could be quite tight, actually. So we're thinking 2 votes for a larger cut, so 50 basis points, and 2 votes for no cut at all. So obviously the bulk of the votes for the 25 basis point rate cuts, but it could be quite a tight one, actually. In terms of the guidance, we're not really thinking anything will change just at this juncture. UK data has been a bit volatile, both on the inflation data and the wage growth data, something the BOE is obviously focusing heavily on. But at the moment, we sort of think that they can carry on cutting gradually. So we obviously, beyond the current meeting, we forecast 2 further rate cuts, 1 more this year in November, and then 1 next year in February for a terminal rate of 3.5%. So that's basically where we see the upper end of neutral in the UK.
Okay, that's so interesting. Quarterly easing at a gentle pace. That's exactly the communication I'm getting from the Reserve Bank of Australia, by the way. Hey, let's turn to Europe mainland. We had Q2 GDP out this week. We've got a fresh Centex investor survey coming, final PMIs. Any thoughts there? I wanted to ask, what's your sense of the underlying kind of growth pulse in Europe right now?
No, sure. Look, in terms of the most recent GDP growth data, I think the key takeaway for us was that domestic demand is kind of resilient in some senses. That said, the print itself was fairly weak at 0.1% Q on Q, but this was really a net trade story. So you had that unwind of the front running of tariffs in Q1. Going forward, though, we do think growth will accelerate. Maybe I'm playing a bit fast and loose with the word accelerate. We're forecasting 0.2 in Q3 and 0.3 in Q4. But still a sort of gradual uptick in growth over the coming quarters. In terms of the Centix survey, as you mentioned, we do forecast a rise in that survey. I think it's worth caveating. Obviously, a lot will also depend on the data which comes out post recording of this podcast. So the non-farm payrolls and the impact on equity markets can really have a material impact on that Centix survey. That said, it's really a survey of financial sentiment, and so what I'd say is, or caveat, the read through to the real economy is less clear cut sometimes.
Okay, understood. And finally, let's talk trade and tariffs. We've been discussing this one a bit, but new news just keeps coming. The deal that has been announced for Europe, I guess final details could still change. But as it stands, what are your thoughts? Is this going to hurt?
I think, as you say, the final details, they still could change. And I think markets do feel complacent in some senses. And I think maybe markets are sort of pricing in further de-escalation in that sense. But as the deal currently stands, it's essentially 15% US tariffs on Europe. Europe will not retaliate because this is a deal. So in terms of the growth impact, it's quite material. I mean, the ECB obviously didn't do a sort of 15% scenario, but a 10% scenario would lower euro area GDP growth by 80 basis points this year, next year, and the year after, cumulative, that is, obviously. In terms of the inflation impact, very muted, though. A 20% tariff scenario where Europe retaliates would lower euro area growth by 180 basis points over that cumulative over that same time period. Obviously, given what we know about the sort of deal, essentially you have the 15%, it also applies to autos, and apparently it should also apply to pharma when it comes in, when the sort of pharma tariffs eventually come in. And obviously, because there's no retaliation, it means the current deal is closer to the ECB's 10% scenario rather than the 20% scenario. But nonetheless, obviously, it is a meaningful hit to growth, and it does mean that it's obviously essentially the question is how that then impact inflation further down the line. And that's the big caveat. We've had some inflation data over the past week. There's so far been no sort of impact from US tariffs on that whatsoever. So I think that's the sort of thing we're going to be monitoring going forward.
Okay, understood. Andre, great to chat with you. Thanks so much.
Thanks, Andrew.
Okay, now moving to Asia, I'm lucky to be able to chat today with Sonal Varma, our chief economist for India and AEJ. Hey, Sonal, let's start with India. We did have that tariff announcement this week. Can you give us a quick take on that?
Yeah, hi, Andrew. So on net, actually, disappointment given India was the front runner, or at least the supposed front runner. It basically got a tariff rate of 25%, which basically is in line with what was announced on 2nd April of 26%, plus a penalty on India's purchase of any Russian oil and military equipment. We don't know what this penalty is, but the reciprocal tariff itself is high, and importantly, relatively high compared to what the other ASEAN countries have actually finally negotiated. So it's quite negative in our view. Now, the deal is not done. Negotiations are still ongoing. And from the India's standpoint, they are expecting more negotiations to continue over the next 2 to 3 months. So we think the 25% rate could get negotiated down. But the clear takeaway from the deals that the US has done suggests that the best case scenario for India would be a tariff rate of 15 to 20%, which is still a negative on growth. So we think on the whole, relative to our baseline, this could drag GDP growth by about 0.2 percentage points this financial year. And we think it's going to add more pressure on the RBI to actually support growth via policy easing.
Okay, got it. And hey, you've previewed my next question. I wanted to ask you about Reserve Bank of India. They are out next week. So do you think their take will be similar? What do you think we could hear from the Reserve Bank of India?
Yeah, so our view is it's going to be a dovish hold from the RBI next week. And I think the context to this meeting is important because at the previous meeting in June, the RBI surprised with a 50 basis point cut. And they had also changed the stance to neutral, basically to signal that they had front-loaded easing and that the bar for the next move or the bar for a cut was quite high. Now, that basically set expectations for a pause, which is the consensus and our view for next week. But I think two things have changed. One is this trade deal is worse than expected. We don't know what the RBI exactly was assuming, but I think 25% is definitely much higher than what they had assumed in their baseline. We don't know where tariff rates will finally settle, so RBI may not change its growth projection, but risk is clearly to the downside. And second, inflation has actually undershot the RBI's projection. So their midpoint target is 4%. Their projection for this year is 3.7%. And we're actually tracking below 3% for the year. So the combination of growth and inflation actually tilts towards more policy easing. We have increased the probability we assign to a potential surprise cut in August to 35%. We earlier thought it was 10%. And the important takeaway for us is that the easing cycle from the RBI is not over. We are expecting 2 more 25 cuts in October and December, which is more than a consensus, which is broadly believing that the RBI's easing cycle is done.
Okay, got it. So slightly higher risk of easing, but still the base case is not yet, but still some more down the track. Got it. That makes perfect sense. And Sonal, finally, I know you and the team there cover a lot of countries across the region. There's a number of releases coming out next week. What will you be watching? Anything you'd like to highlight?
I mean, first of all, I think wherever the final tariffs end up for most countries, I think the ramifications of that we'll be looking at. But beyond that, a lot of growth and inflation numbers coming out. So we'll be getting CPI data for a number of countries. We're expecting largely inflation to be stable relative to the previous month. The underlying trends actually are benign across countries for various reasons, low food and fuel prices, low wages, weak demand. So core inflation should be low. In fact, in Thailand, we're expecting another negative print on inflation. We'll also be getting the GDP data for Indonesia and Philippines, which we think will moderate, and China's export data, which we think there'll be a slight moderation given some signs of end of export front loading.
Okay, got it. Sonal, that's excellent. Thank you so much.
Thanks a lot, Andrew.
And now, elsewhere across the broad Asia region, I'm going to finish with a couple of super quick highlights. In China, we expect export growth to slow to 4.5% year over year in July. That's down from 5.9% previously, as the impact of front-loading pre-higher tariffs starts to fade. In Japan, we estimate a rise of 2.3% in total cash earnings. That's year-over-year data to June, and that'll be stronger than the 1.4% growth recorded in May, noting that wage growth remains a critical input in BOJ rate hike thinking. And last but not least, in Australia, we'll receive June household spending and trade data. That will help us firm up our Q2 GDP growth forecasts. At the moment, we think that growth in Australia in the June quarter was likely quite respectable at a roughly trend pace. Okay, so there you have it, our views on major market themes and what to look out for next week. This podcast has been written by Andrew Ticehurst and the Global Markets Research team and expertly edited and produced by John Dalton as always. Thank you for listening in. If you did enjoy the podcast or would like to hear more, please like and subscribe to Nomura's podcasts on Apple, Spotify and SoundCloud or wherever you go for your podcasts. And if you have a moment, please leave us a review. And as we always say, it would make our day if you could press a few buttons and share this podcast with a colleague or a friend. For more, log into nomuraconnects.com to keep up to date and to keep on listening. Thanks, goodbye for now, and see you next week.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.